Hello everyone. Um, Let me start with, first of all, thank you, smallcase team and Piyush, for hosting me on your channel. Let me get started, and thanks everyone for joining on a Sunday morning. I'll share my screen and we can get started right away. Perfect. So I'm assuming everybody is able to see my screen. A very brief introduction. My name is Chanpreet Singh, and I am a founder of AltQube. It's a fintech company, and we are a wealth management SEBI registered firm. And the topic for today is basically next gen investment strategies. So what I wanted to talk about in this topic was basically there is a lot of discussions around quant based solutions, that a lot of data and AI is being used to come up with various investment strategies. And then there is a very different school of thought around people kind of doing very fundamental and saying this is how strategies needs to be built, right? And what I wanted to cover in this section is that these are not two topics in silos, and I want to kind of bridge the gap between the fundamentals and the quant. And this is the topic of bridging with economics and AI, how to really build investment strategies. So that's the topic. But before we deep dive into the topic, let's start with a disclaimer. Given we are a SEBI registered firm, so a disclaimer is mandatory and from a compliance perspective, that there is no suggestion of investments here, and whatever you invest is subjected to market risk. And we are SEBI registered, we are a member of Basel, but that does not mean any guarantee performance from our end as well. And this, whatever we'll discuss, is all just for an illustration or for a discussion, but not recommended. So yeah, so let's start with the discussion outline. So what I want to talk about is basically four topics. Is let's start with context setting, because when we'll talk about fundamentals and efficient market theory and other concepts that are related to investment management and strategies, I think let's start with some examples, understand the key concepts. So that's how I want to kind of start this discussion, followed by talking about various components or building blocks of investment strategies, be it AI, the role of technology, the role of alternative data, and how fundamental concepts are very key to all of these concepts. And we will also kind of see an example in an Indian banking sector of how all these components fit together in the Indian banking sector example of so that it becomes more relatable and you can actually appreciate the role of various components when it comes to building investment strategies. Once we kind of deep dive into those different roles of other components, we'll talk about AltQube, of what is our investment philosophy and our products on small case platform, and then we can just go ahead with a Q&A session. So I intend to keep this discussion probably in next 40 minutes. I want to wrap up this discussion, want to touch upon all of these topics, and then I'll keep another 15-20 minutes for questions, so you can shoot all your questions and we can have a more engaging discussion that way. So with this, let's start with some context setting, right? And this is how I typically like starting is a very interesting story, a story of an economist. So here it goes. Here is how it goes, right? So economists are said to be they're not great traders, right? And there is a reason for it, and why you need technology and all those things to start with, right? So let's start with this story. So here goes the story. Is there is an economist, and he was kind of looking into all of his data, the different commodity prices, the equity prices, all those prices, and he was also kind of analyzing some of the other data points, GDP, inflation, and all. So this economist friend of ours came up with an observation, a very simple observation, that Brazil unemployment rate was actually impacting copper prices. And then, being an economist, he started digging deeper into it, and there was a reason for it, right? Copper being a commodity, the price of a commodity would be basically nothing but the demand and supply game. So and all the mining of actually copper happens in South America. So Brazil, given a major country in South America, so if people are unemployed there, that means they are not mining copper. And because they are not mining copper, the supply would be less, and prices of copper can go up if unemployment in Brazil goes up, right? So this was his observation, and he thought, okay, I have a nice idea. Let's start doing business. So he used this insight and he started coming up with a copper derivative trading. And where what he used to do is he used to check the Brazil unemployment data, and if the unemployment rate is increasing in Brazil, he used to buy copper prices, basically buying copper future contracts. And he started making money out of it, right? So every time report comes, our economist friend kind of goes in the market, buy copper futures, and he makes money out of it. But this is not the end of the story. Now, given whenever this report used to come out, now market has picked up some volatility, and there is a concept called FIs and DIs, which is foreign institutional investors and domestic institutional investors, or rather the big investors. They also picked up the same pattern. They said, oh, they also found this same relationship to exist in the system, that whenever your unemployment in Brazil is going up, the copper price is actually shooting up. They also started trading on the same insight, right? Then what happens next is, the FIs may or may not make money, but our economist friends started losing money. And this is why it happened. So by the time the report comes out, the economist kind of analyzed that report, takes his own sweet time, comes up with a conclusion of what to do with copper prices. But by the time he goes to the market and places order, the prices were already very high. And why does that happen is basically because even before he could compute and find out those insights, there is somebody, the FIs and DIs, who are more tech oriented. They had the technology and the manpower, or rather the resources, to analyze and process that information much before the economist. So before even the economist who actually started trading copper goes to the market and buys it, these guys started, they already buy it because they are big investors. They've already inflated the price of copper. So whenever the economist was buying it, instead of pricing going up, they started going down, right? And this is where the role of speed comes into picture. So what I want to touch upon this topic is that economists lost money not because his insight was wrong, but because he was taking too much time in processing that insight. And this is where the role of technology comes into picture. So what happens next, right, is, and this is basically called efficient market theory, where if all of us have the same kind of information, nobody is going to make money out of it, right? And this is let me give you another example to maybe appreciate this theory, right? So today, let's say on this channel, I kind of somehow says that a stock A can go up, right? And all of us kind of, get this information, and we all kind of buy stock A because tomorrow it is expected to go up. What's going to happen is, within no time, because everybody has bought it, the prices have already shot up, right? So given this information was with everybody, nobody would have made money. The only person who would have made money is who had this information a little before, because he bought at the right time. So this is called efficient market theory. So what I want to touch upon, why this story is more important is that though fundamentals were important, it's not just the fundamentals that are going to make money consistently, because markets are very, very efficient. Eventually, it's the right information processed at the right time, or rather processed before anybody else could do. That is the only way to make money. Otherwise, you are too late in the market, and efficient market theory will kick in. People will start trading on that same information before you, or at the same time when you are doing it, and then making money. You may make it, on a short-term basis, but consistently making money would be very, very challenging, right? And this is where the role of different players would come into picture. And then what happens next? The trader, the economist who turned out to be a trader, actually again went back and became an economist. And then he again started writing theories, economic theories, but again, he was not able to make money. So the long story short is, economist explained the theory, there is a logic behind it, but when it comes to money making, it is also, it is a necessary condition, but not a sufficient condition, because you need technology to, kind of process that information very fast. You need a lot of other information as well. How do you, and it's all about who processes it at the first hand, right? Because that is the point where the market prices would be the best price, right? So what are the key takeaways from this story, right? One is that economics and finance is still fundamental, right? You want to target a commodity market, which is crude oil, natural gas, gold, copper, whatever you do, or you want to target the equity prices or any other forex market, eventually any financial asset, even the real estate, which is not a listed product, but still even a real estate. Of course, there are ways to kind of trade on the real estate as well these days. But yeah, the whole idea is that the fundamentals will never change. They will still be very, very foundational to whatever you develop. So it's a necessary condition to come up with an investment strategy based on fundamentals, but may not be sufficient in the longer run. What is the second takeaway, right? So the second one is basically alternative data. Is that if, let's say, if somebody wants to really model the copper price or an HDFC stock or an equity or a Nifty index, whatever the asset is, it's not just important to capture the historical trend of that particular asset, right? So of course, that is, again, I'm not saying it is not required to do that, but it may not be necessary. So your approaches like, technical approaches or, momentum, volatility, they are important, right? To understand the asset, how it is moving, to understand the sentiments, to understand institutional footprints, all those concepts are important, right? But at times, if you're really trying to model an asset, it is equally important to also kind of see the other information, right? So if I'm trying to understand the copper prices, maybe, the GDP of Germany and China is equally important. The unemployment rate and situation in Brazil is important because Germany, being an automobile sector, demands, is driven there, or China is driving the demand. The supply is actually being happening on the South American side, because that's where copper mining is happening. So what I'm trying to say, commodity is just one example. I will also pick an equity example with a similar scenario. But the whole idea is that, you have to look into the other data sets. These data sets holds the key, because this is where you can get a competitive edge, because everybody else is anyhow analyzing a lot of historical data, from technical indicators to momentum to factor to, volatility. All those things are already being analyzed, and at times I believe it's a very saturated market. So how do you really kind of, pick the other dimensions of the data? And that's where alternative data comes into picture. And I think these are the concepts which we will talk about in depth. And I wanted to touch with a story so that it becomes more relatable. The third point is, and I think this is one of the learning here, is that information at the right time is important, in the sense that when the economist started trading, he had the right information, but later he started losing money because he had the right information not at the right time, because by the time he was taking time to analyze that report, read the numbers, come up with some theory, go and buy copper or sell copper, it's not the right time, because before that there are smarter people who have used tech to kind of do all of that work, right? So right information is important, but if you want to make money out of it, right information at the right time is also important, right? And to get the information at the right time, especially in the digital era, right? We all from chat, I think we have evolved from chat GPT to, where all we are going. It's a technology era, it's a digital era, right? So information processing is so fast that, if you're trying to really do it manually, it does not make sense. So there are two aspects to technology. One is processing it faster. The technology plays a role. And maybe in this example, the FIs would have kind of just automated a process that as and when the Brazil government would, come up with or publish or release a report, they will just, read it automatically, analyze those numbers by some quote unquote, PDF reading software by AI, and they would have even built a model out of it, and it would entirely take like 2-3 seconds of a process eventually. Versus, as humans, we might need at least 3-4 hours to analyze that report, right? Second thing is not just the speed, but the amount of information it's there, right? It's humanly not possible to kind of really analyze so much of information. Every day there are like 30-40 economic reports comes from different governments, and your central bank reports, their websites, the information and numbers they publish. It's an overloading of an information, right? So again, humanly, it does not make sense to kind of really analyze each and every report. So if you want to build a scalable, robust solution taking care of a lot of factors, you have to deploy machines and technology for it, right? And that's where the key is. And this is what our topic of the discussion for today would be. And this story was to kind of, give you a little bit of gist of, how typically things work, and why there is a saying that, institutional investors makes more money, or rather they are more consistent, and retail investors do not make money. I think some of that part or theorem is actually attributed to this story, where you might have the right idea, you might have the right data points, but, by the time you process and do things, you lose the game. Okay, so let me move on to another thing, which is, so basically after this theory, I want to talk about is, not talk about, let's say, copper, because I want to focus on the Indian market. I wanted to talk about the Indian banking sector. So what we are probably going to do is pick up a very basic use case of an Indian banking sector, where technology plays a role, where alternative data plays a role, where fundamentals also play a role, and how do all of these things get ties up together, and we kind of, look into or dig a little deeper into each of these roles and how they actually play a role. So let's start with, our first example. Yeah, 1 second. Okay. Okay, yeah, sorry. So let's start with this example of an Indian banking sector, right? So when we're talking about AI technology, it has to start from somewhere. So if somebody has to build an investment strategy, it has to be tied together. It means there is something that needs to be started, and you have to connect all the dots. So let's start with something, and that something can be any ideation of a strategy starts with some concept, right? So, and those concepts come from data. So, for example, some of the relationships, just to kind of set context, is that if you see Nifty IT index, right, it's positively related to the S&P 500 movement. Now, this S&P 500 is nothing but like we have Nifty in India. In the US market, we have the top 500 companies globally, or US companies. So it's very common and kind of intuitive that if these S&P 500 companies grow, most of the Indian IT companies, your Infosys, Wipro, TCS of India, all those companies, basically their clients are US based. The majority of the clients are US based. So if US economy is showing a strong growth, they get more projects, so they get, their profit goes up. The second thing is that because the US economy is going, the dollar strength goes up, so you are paid in dollars by your clients and you have to pay to your Indian employees in rupees. So that's another way of increasing the profit margin. So Nifty IT will definitely be so S&P 500 has a positive impact on the Nifty IT index for all of this reason, right? And this is intuitive and explanatory. But when you're analyzing these things, you at times get a lot of counterintuitive things. So I want to pick a counterintuitive things and explain through alternative data approach of how this still makes sense to us, right? So Nifty banking index is actually negatively related to 500, S&P 500. Now this becomes a little counterintuitive, that basically if I really want to say, I'm actually claiming a statement which can be contradictory to say that S&P 500 is doing a good growth, then basically, it's negatively impacting the banking sector. And I want to pick this topic, go into the detail of how a counterintuitive approach with data becomes intuitive and becomes part of, how you really build solutions out of it. And then, just picking up example of, apart from the equity side of it, apart from Nifty banking and all, people who kind of invest and trade and hedge, natural gas, gold and all, they also have these similar relationships, right? Natural gas, the demand of the natural gas, at least in, it's traded in Henry Hub, is how the US weather conditions are, because the majority of the natural gas demand is for warming purpose. So if US has a cold winters, your natural gas prices obviously goes up, right? So, and then so on and so forth. We can pick like gold prices have a relationship with US unemployment data, because US kind of owns or rather have the largest forex reserves, and so on. I can just go on with all of these insights. And one, at times at a superficial level, from an economic perspective, these can be intuitive. It can start with a fundamental hypothesis, and economists can come up with these insights. At times what you can actually do is combine all the data that you have and let machines kind of figure out some of these relationships. So for example, if I have all the macroeconomic data with me and I have all the Nifty bank IT index and S&P 500 index, times I can do this is something called data mining, where you can actually mine these insights and your system will say, okay, these are the things that are related. Now, does that mean we can directly use them? Maybe not, but yes, it gives a starting point or an ideation for us to start thinking through it, right? So I'll think to how we get deeper into those things. But the whole idea to this is that if we want to generate these insights, which becomes foundational to coming up with an idea of how do you really build strategy, or how a bank index or let's say a stock in a bank can actually be modeled, is where these components comes into picture, which is your how do you bring all of this data in your system, how do you use data mining techniques to find these insights, and then what all different alternative data you bring into your system, so that eventually you can kind of come up with those insights. So so this is just a schematic diagram that this is how the financial report, the global market data, the web data needs to be consolidated, and that is where the role of technology. And so the bottom, if you can notice, I've just highlighted the areas where from economics to technology to data science, these are building blocks of a strategy, where technology, data science and alternative data plays a role. And what we can actually do is, let's pick one insight and dig deeper into it to understand each of this role, right? So one of the insight that I want to pick, because it's counterintuitive, is a banking index in India is basically if S&P 500 is doing good, it actually negatively impacts the Indian banking sector. So why does that happen? What is the role of alternative data, and what from a technology perspective we can use to leverage that information? So let me move on to the second slide, is with building assumptions, and this is where your economics and financial theories comes into picture. So the theory is, which we kind of just got an insight and we are trying to build a hypothesis, is that one, the negative impact of S&P 500 on the Indian banking sector. So an economist, if I reach out to an economist and say, oh, this seems to be counterintuitive, why does that happen? And probably, a probable reason would be that FIs, which is foreign institutional investors, have invested very heavily in the Indian US market, Indian banking sector. So if the US economy is doing good, basically they tend to take their money out of India and put in their own economy because their economy is doing decently well. And now when they have to take out their money, the only way to take out their money, which they have heavily invested in Indian banking sector, is selling the shares that they own. So the moment US economy does good, these FIs need money. And because they need money, they sell Indian stocks where they have heavily invested, especially in the banking sector. And that is where the selling pressure grows, and the Indian banking sector probably see a south side. And it kind of, the selling pressure, or the buyers kind of go less, and sellers are more. But again, when I say all of these theory, this is an economic theory. Somebody can kind of agree to this, but somebody might contradict that it is just a theory, because somebody else can come and say, no, this I does not believe in it, because if US is doing good, this would have impacted positively to the US market. And this is where your data comes into picture, is that the insight or the ideation was just an idea, which came from some of the data points and data mining that you were doing. Once you find something which you feel has a strong relationship, you actually start assigning economic relationships and assumptions based on the understanding that is being established over decades with financial theories and economic theories. But then the most important component here is validating with data. And let me share you some data points. If I have to believe that this theory of US FIs pulling in money is not just a theory, but basically it's shift it here. Sorry. Yeah. So the whole idea is that when I actually realized that, okay, I have a relationship of Indian banking sector, we picked all the major banks in the Indian market. So Axis, HDFC, Kotak, ICICI, all these banks. And then we separately built a correlation of these banks with basically the S&P 500. And what we actually realized is that Axis Bank had the most negative impact. So if US markets are doing good, the worst, performing bank was actually the Axis Bank, and followed by an HDFC, then Kotak, then ICICI, and so on and so forth. The another interesting relationship, because when we captured another data points, is that we also monitored what is the holdings by FIs for these banks. And we realized that, Axis Bank almost 53% was being held by the foreign institutional investors, followed by HDFC, which was 47, and then Kotak, which was 37. So now, assuming whatever an economist was saying, that the reason that, Indian banking sector was negatively impacting, so S&P 500 was negatively impacting the Indian banking sector, if this economic theory has to be true, the FI theory that we just claimed, this data actually validates that. And the only way to validate that data is unless you get the holdings data, which is an alternative data points beyond a price data point for all the banks, because that does not have that information. Unless you add this information, validate it, you will never be sure whether that economic theory is correct or not, right? So what all I'm trying to bring to the table is saying that, an ideation typically starts with a lot of data where you get interesting insights, which at times are intuitive, at times they are not. Then what you do is, with those insights, if they are intuitive and you believe there is a strong relation that can be exploited, you start building economic theories out of it, or rather economics theory or financial theories. Like in our example, it was the Indian banking sector. So our theory was that given its Indian banking sector, okay, there is a high chance that I can build some strategy, and because it is very negatively related with S&P 500, let's come up with something, right? So we build a theory, but these theories also needs to be validated. And to validate these theory, you cannot just look into the historical prices of that particular equity. You have to look into other data points beyond those price data points to validate that theory, because unless you don't validate it, you cannot leverage out of it. Otherwise, it's like, you're walking in the dark, just building a relationship without knowing why you are building those relationships, right? And this is where, alternative data and economics will play a role to come up with those validations, right? Now, so this is where, we try to conclude based on the data, was that if a bank has a more FI investments, then the US market impact would definitely be higher, and they will be more negatively linked with S&P 500. So, bank like PNB, SBI, and, maybe, I think Bank of Baroda was an exception there, but, SBI, PNB, Federal Bank, they don't get negatively impacted when the US market does good. But banks that have taken a lot of money from the FIs, or their, the promoter, the holdings by these FIs is very, very high, of course, they do impact it, right? So there's two more lessons here, right? One is, it started with an index relationship. But now when we started digging deeper into finding why actually that happened, more than index, now we have more conclusive and deeper insights to say that, okay, I can say at a very high level that the S&P 500 is actually impacting the Indian banking sector. But now I can go a little more deeper to say the impact on Axis Bank, HDFC, Kotak, and ICICI would be much higher, and the impact of PNB, SBI, Bank of Baroda, and IDFC would be much lower if the US market does well tomorrow. And given these relationships are month basis, we can actually leverage it to build a solution out of it, right? So it's not just the validation of an economic theory. So when you follow that path of validating those theory, you at times even get more deeper insights that can be leveraged. So the insight that started at an index level now is at the stock level, right? So now the question is, okay, we have built this relationship, and now we can write a rule-based engine and say, okay, if this will happen, we will do this. If this will happen, we'll do this. If S&P 500 does well, I'll short banking stocks, and if S&P 500 does bad, I will actually buy Indian banking stocks, right? But the whole idea is that it's not that straightforward, because it's not just one factor that will play a role, right? So there will be a multiple factors, and this is where the third block comes into picture. That today you got some information about an Indian banking sector and how they are ideally related to the holdings they by FIs, but there are much more to it. The RBI interest rate, the macro conditions, the overall sectoral growth, the India's growth, election. There is so much that play at the same time that by using one or two or three factors, coming up with a conclusion might not make absolute sense. So this is where the third part, which is very, very loosely say that there is a lot of machine learning being used in investment strategies these days. I think this is very niche of where exactly machine learning modeling is leveraged, right? The part of AI that we use is basically that this was the FI holdings and its relationship with S&P 500 was just one example, right? And if I would have given you, let's say, 200 such insights, and I would have asked you, okay, all these have individual relationships. Now you build a solution out of it. Now, it's not humanly possible. Imagine how you're going to write it. Let me think of it that way. If US market does well, then I will not buy banking stock. But if RBI has increased its interest rate, I will do this. And if this has happened, I will do this. So there is so much of combinations. If let's say 100 or 200 variables, it's humanly not possible to come up with some sort of a strategy. And this is where the role of machine learning modeling comes into picture, where and it's part of the AI, which is very, very people who are into the IT sector might really understand, is that you start building predictive models, because these models have the capacity to kind of take all the factors at one go and start making predictions out of it. So the advantage is, rather than looking at one factor, I can look into hundreds of factors altogether and can make predictions about the equity market. And this is what the third block comes into picture. So if I try to summarize it, like, it starts with some data, some insights, then you build some economic hypothesis around it, then you start validating those hypotheses with data. Once you have validated it, you still start believing into it. Then you put that as one of the factors in the model that you have actually built. So you will need a good number of factors to be very conclusive about a stock, rather than just being dependent on one factor. And this is where the third component comes into picture, is basically you take all of this data, and typically in the IT side, we say, we process this data, we build the model, and we validate whether that model, how good it is, accuracy, the precision, recall, all those factors we validate. And we start predicting a stock performance. So basically, this is some sort of providing a score or a rank to each of the stock. So based on all the factors that we have already established and validated, right? So this is what the third component of a machine learning model, which takes all of these data and start predicting it. Okay, now there is the last component or the last piece to it. But here is the thing that I want to discuss about is, let's say even I stop at this step. So now what I know about the entire solution is that I can take a data, I can validate with economics and financial theories, and if I find it to be an interesting feature, I add it in my model, and I keep on adding more and more features, and I start predicting the stock performance. But from a portfolio perspective, or from a perspective of investment, this is not where things end, because investments is never about finding a direction to say, okay, HDFC is going to do good, I'm just going to go ahead and buy it, right? There's a lot more theory to it, right? Is whether HDFC will do good, but what is the loss that, or the risk that is attached to it? If I'm building a portfolio of stock, how much within that portfolio, how these stocks are related, what is my risk? Because investment journey is never about, what returns you are targeting. It's always about what returns you are target at what risk you are taking. So the fourth component, which is basically I'll talk about, is the portfolio optimization. Talks about that, okay, now with the machine learning model, with all the data and economics that we have applied, we just know a direction of, where these stocks may move, right? But the fourth component is what is portfolio optimization, is basically one, understanding that, okay, what is the final numbers? What is my performance number? We have to find those. We have to find, we have to maximize returns, and it can never be that, we just build a portfolio with this performance number and say I want maximum return, right? We have to make sure that, it should be adjusted returns, in the sense that if I'm targeting higher returns, I will also have to check what risk I'm taking. So if I have similar type of portfolio, or similar, sector exposure is very, very high, one particular sector exposure, it does not make sense there, right? So this is where the fourth component comes into picture, is we start building, portfolio optimization solutions, where once I have the directional input as a, my model have started predicting it, we start testing with those numbers. We see how do we maximize and optimize it for maximum risk adjusted return, whether the risk control are within the limits. Because like I said, if there is a very high sectoral exposure or similar movement type of stocks are all there in one portfolio, that's a very highly risky portfolio, right? So we kind of do all of those, and that's where, even after knowing what good and bad, portfolio development takes one step more to, also understand the risk, the way you kind of, model it, and the interrelationship between those stocks within that portfolio actually makes sense. And this is where the from a very schematic diagram, how things look like in how it ties up, right? Is we started with something with insights, validated with economics. Once we were comfortable that yes, it has an economic sense as well, then we build a model which could take all these insights together to kind of, process the information. And then of course we have a portfolio optimizer to kind of, optimize it. And this is where we kind of build a final portfolio. So the bottom 5 blocks that you are seeing, at every stage, different blocks are required. At the initial stage, it was just the data and the economics. At the later stage, it was technology and data science. And at the last stage, it is portfolio optimization. You can't run away from those risk-related things that you have to take into account. And it's not just about prediction. So this is how it typically, the entire schematic of, how things look like. Okay. So, and this is where I want to, of course, I missed out on one line, which I definitely want to highlight, is that, which I said is that when you are making an investment journey, it's never about returns. It is about you generated some returns at what risk. So for example, you're investing in more in small cap, right? Small cap portfolios are very good. They give very good returns, but they also give you a high risk, right? So if you go back like 4 years back during the COVID times, 2020 and all, the fall in small cap was the highest. The volatility was the highest. And there is a simple finance theory, right? Risk and return both goes together, right? So the more returns you target, the more risk you have, right? So it is never about that if one portfolio has given you, greater returns than the other portfolio, then the first portfolio is actually better. It may or may not, because the most important component to any of the portfolio performance is you got some returns, you generated some returns, and at what risk you take, right? People putting in FD have their own theory of putting money in FD. And to an extent, they are not wrong, because they are actually taking no risk. The only risk is the banking risk, which of course is secured at least till 5 lakh. So of course, the risk is lower, the returns are lower. So nobody can say that asset is bad. It's just that, it's good for somebody. It may not be good for somebody. You can target something to be, highly risky, and then you can expect to be, high returns. The only thing you should not be doing is you take a higher risk and you're not targeting extra higher returns, right? That's the only thing. So it has to go together. You're taking more risk, expect more returns. You are targeting small cap, makes sense, more returns, more risk. So is go with large companies, with gold, all of these assets that we have in place, right? So with this, I just want to summarize things of, different type of roles that each of the component have. But let me move my image first. Oh, yeah, perfect. Okay, so one is, I think we highlighted about the role of economics, which is basically, and given it was just a 40-minute discussion, I was able to just scratch the surface. All of these topics are, ocean in itself, and probably, some other discussion, some other forum, but at least to, at a very surface level, we discussed about the role of economics, which is basically one, it helps in ideation. Second, it also provides you a direction on what alternative data you need to build your solution. For example, if I wouldn't have kind of, read about more about economics and how the macro and micro conditions of Indian banking sector sector are changing, I would have never went in the FI's data and collect it in our Indian retail banking. Or probably if I don't know, where the copper supply happens, why would on earth I will actually go to Brazil and capture their unemployment data? So the whole idea is that it gives you a direction of what actually needs to be done. Fine. Second is the component we talk about is alternative data, is basically moving beyond just the historical data and finding momentum and all. It's about finding another data points that actually impact your financial asset, right? Like the two examples we gave, right? Brazil unemployment impacts copper, the S&P 500 movement, Indian banking sectors gets impact. So these are different, or rather, alternative data itself is the field of, non-traditional data sets that you use. So I'll highly recommend, there is a marketplace, alternativedata.org, where you find all these alternative data for all the different investment strategies. Very interesting place to visit, right? The third is the data science part, is basically, imagine with 200, 500, and this can go to whatever higher limit. There is no upper cap to number of factors. You need data science to process so much of information in a very accurate way. That's one side of it. The second side of it is that, in this digital era, building those robust mathematical solutions gives you more confident, and you can actually go back, test these solutions for 10 years, 12 years. You can do all of these things, and only then you can be confident about how your strategy works. So using data science, or rather data and science, in silos, makes a lot of sense, right? Especially in this digital era. And then the fourth component, technology. I think whether you want to apply data science, you have to collect all the data at one place. You want to automate your solution, so you want to eliminate a human bias to say, okay, I build a solution, I'll just deploy it. I'll build an API that will give me the final output, and I don't want any human intervention. Because investment, I think one of the key factor people, or rather smart people, don't make money is because of panic, greed, all those things come into picture. So if you are one of those, probably automating these solutions using technology makes a lot of sense, because in that case, what is actually happening is that you are not putting your own bias or your emotions into picture, and that's where technology has a role here. And then the portfolio optimization that I talk about is, one, you have to validate those strategies. You have to find those optimal parameters, whether the portfolio should be, weekly rebalanced or monthly rebalanced, or, what all you actually want to kind of, find out those things. So if you want to minimize your risk, or there is a concept which, if people are interested, is something called being on efficient frontier. That means if I'm taking more risk, I need more return. And if I'm taking more risk and I'm not getting more return, then I'm not doing or managing my portfolio efficiently. So you will always have to manage it efficiently. You can decide your own risk, and then you can expect your own return. That's a separate thing. But you have to be efficient. It should not happen ever that you're taking more risk and you're not getting more returns out of it. Then you're not managing it efficiently. So optimization is about making sure that risk-adjusted returns are always maximized for you, not risk, but risk-adjusted returns. So, and this is, I think, the core foundational block of what we do at AltQube. So now coming on, because I think we are very limited with time, I just have 2 minutes to close. Then we have 20 minutes to kind of have a question and answer session. So last 2 minutes. So with these approaches and all, we have 4 portfolios on the small case platform. So we are built separately for a blue chip, which is a large cap portfolio, then a small cap portfolio, a rising star, which is mid cap portfolio, and multi cap, which has all different categories of stock. So for today, as of now, we have only market cap related portfolios, and these are the 4 portfolios that are there on the small case platform. We do have plans to launch more, but yeah, for now, this is what we have. Okay, and yeah, and so just to kind of highlight it in terms of risk level, the fees, the rebalance and frequency, and your stock universe, and all those information are there on the table. Probably I might not have a lot of time to kind of go through those. And if somebody wants to kind of do a checkout, we have an AQ25 coupon, which is a 25% discount. I think it's a public available till 10th of May. It's available for people who want to subscribe for it. So I think I am probably bang on 40 minutes. I have wrapped up this discussion. Let me kind of go through the questions that we have, right? Okay, so let me start. I have these questions on my WhatsApp. So, okay. Okay, one I think is Ved has asked is, how do we manage risk, right? So here's the concept, right? So when we're talking about the 4th block, which was basically saying that, I know the predictions, I know where the stock markets are moving. Now I can build a portfolio. So a simplest approach would be, pick the one that has the highest rank and say, okay, this is my portfolio because these are the top 20, top 10, top 15 stocks that will have the highest movement or predictions. But the question here is that beyond those predictions and all, what happens is, let's say I have picked only 20 stocks and all those 20s are from banking sector. So the problem there is that if the banking sector does well, all my portfolios all are related to each other, and there are high chances that all will kind of fall flat there. So controlling, making sure that one sector is not very predominant in a portfolio is one way of making sure that risk is being taken care of. The other thing that we look into is relationship between the stocks, right? So if I have a stock A and B, both are in my portfolio, and when I build a relationship between those combination, I find that A and B usually have an exact same movement. So it is not wise for me to have both the stocks in that same portfolio, even though they might be the top performing portfolio. I will probably pick one and not the other one. So within a portfolio, making sure that these combinations are taken care of, not all related or correlated stocks are within one portfolio is a key to it. So we take care of those things. So I think sectoral performance and relationship between these portfolios, I think, makes sense. I just hope that answers the question. Okay, the question from Aditya is, how many stocks are there in one portfolio? Typically from 10 to 20 stocks, depending on how much diversification or risk we want to manage. So if markets are very uncertain, we typically have more number of stocks so that diversification can be taken care of. If the markets are probably certain and the trends are very positive, then probably we go with lesser number of stocks, but bare minimum we keep 10 stocks to make sure at least to some level the portfolios are always diversified. So within those 10 stocks also, it would be diversified within sectors. But yes, the maximum limit we go is 20 stocks in a portfolio, and the minimum is 20 to take care of diversification, at the same time making sure that we are taking an advantage and not going the average route. Okay. Then I have a question from, okay, what is a benchmark of your performance? Okay, so the benchmark of the performance is basically depending on what portfolio it is. So we have 4 portfolios as I just showed. So a blue chip portfolio, the multi-cap, the small cap. So a blue chip is given, it's a large cap company's portfolio. So the benchmark would be the equity large cap, the Nifty 100. The small cap portfolio will have the Nifty 250 index, small cap index. Basically, depending on the market cap of those stocks, relevant when benchmark we pick it, right? So like, for example, I said is blue chip companies, it will be large cap because the portfolio is for large cap companies. So the best way to compare it with the large cap index. And accordingly, depending on those portfolios, the benchmark keeps on changing. Right. Okay, how this is different, Piyush asked, how this is different from other quant approaches. See, I would rather not want to club it as quant approach or non-quant or fundamental approach. How do I really want to say is that in a quant approach, I'll say is whether which is more data-driven. In data-driven, you can also just look at the historical price, come up with a lot of, let's say, insights, for example, momentum, factors, volatility, all those things. If you're deriving it from all the historical data, you're still quant-based. What we try to bring in is not just looking at the historical data, we also look into the other side of the data set, which is the alternative data. So it is still quote unquote a quant approach, just that the amount of data and the type of data, we are going beyond traditional data set of historical prices observations to non-traditional data sets, which is alternative data. So that's how it is quote unquote still a quant approach, but with more non-traditional data sets as well to make sure it's more robust and it's more, adjusting to the market, rather, I'll call it. Can I access your performance chart? Yes, you can. So we launched 6 months back. So on the smallcase platform, from a compliance perspective, we did not want to show numbers on this presentation and the webinar, but you can go to the smallcase platform to check the live performance. We were live like 6 months back, so we have this 6 months of live performance. Given this is quant strategies and we have tested it for 10 to 12 years. So if somebody is interested, send an email to me. I'll send you the detailed documentation with all the back testing results and all if they are interested for their own research. Again, no way recommendation of a guaranteed returns there, but at least how these strategies have performed last 10 years. We can share that. You can reach out to our support team or write a direct email to me, csingh@altcube.com. I will be able to answer that. Okay, okay, where do I find these alternative data points you mentioned in the slides? Okay, so first thing is there is a lot of openly free data sources available. Economic calendar is one of the things. every day almost 30-40 new economic events happens with different governments, different agencies kind of publishing it. So that is freely openly available. Then there are a lot of government side websites, like if you are really more on the energy side, you have to look into a website by Energy Institute of America. They publish good number of reports on the overall situation of the energy situation. You go to the RBI website, you get a lot of data around the banking sector and how Indian economy, the unemployment rate, and other data points, right? So this is basically a free data sets. Then there is a marketplace, alternativedata.org. It's like there most of the data set are paid, but yes, a lot of different, from satellite images to traffic data to, there are so many tons of things. They kind of also share that data. You have to pay to the, it's a marketplace, so you have to reach out to the company to kind of get you that data on whatever subscription based or one-time fees they charge you. Okay, you might have many portfolio. Do you see the same approach for all? Okay, so all portfolios from a framework perspective is the same, but from a development perspective, it varies. And let me give you an example of it, right? If I'm trying to build a portfolio for large cap companies are more, dependent on the macro condition. Let's say, for example, HDFC Bank. One, of course, the internal financial statements of HDFC banks would be important, but a lot of, global factors, macroeconomic conditions will impact HDFC stock more than any other stock, right? So, but if I compare it with a small cap companies that has recently started, they're more than macro condition. I think micro conditions, their own situation, their management, their EPS, their dividend start playing a role, right? So the foundational approach of economics, data, clubbing together does not change. All will have the same components. But having said this, when you pick a portfolio, you try to build a small cap versus a blue chip portfolio, the parameters that are going to take a call that, your models that you are going to develop that are going to predict your stock will change, because the parameters that you're using is actually changing there. Okay. If data points, I am still confused. If data points are related, why don't we directly use it? Why do we need economic validation? Okay, interesting. Why do we still need economic validation? Okay, let me give you an example. Like I'm based out of Bangalore. So if you analyze Bangalore's data, the IT sector in Bangalore and the hospitals in Bangalore are very highly correlated. Now, that does not mean people who work for IT actually need more hospitals, but because both of these factors are associated with an underlying factor, which is the Bangalore population growth. Because Bangalore population is growing, the IT sector is growing, or rather the other way. Because Bangalore population is growing, the number of hospital requirement also goes up. But if you build this relationship and you do not validate that why that happens, at times what happens is you don't get interesting insight. So rather than building a a portfolio that, or rather a movement, if I want to predict to say how Bangalore IT sector will grow, it is better for me to use population as a sector, as a variable, rather than the hospital number of hospital, because they would be closely related. So unless you don't go to the economics of it, the problem is you don't get the deeper insight. You might build a solution, but when that solution will fail, it might work for a year or two because data told you a story. But after 2 years, if that falls flat, you will never get to know the reason. So it's important what parameters and value you use has to be validated with economics and finance so that it makes sense. And when those economic theories goes other way, you will know the reason when your strategies are failing. And that is why it is very, very important to validate economics and finance theories to make sure, whatever you are using is not just a we call it spurious correlation that, Bangalore IT and hospitals are related. Of course, that does not make sense. Yeah. Okay. Mubarak has a question is this model a value based or growth or quantitative based, and are considering free cash flow while selecting final portfolio? No, we do not consider free cash flow, to be honest, but see, value, growth, the parameters that you are talking about, Mubarak, how it happens is somehow the data that we are collecting reflects that. For example, a value of a stock is of course one of the way to understand the value is the EPS or the dividend they are sharing, or the growth of the stock is driven by the momentum of it is capturing, the volatility it is capturing. So when we were talking about the third block, which is building a machine learning model, we take into account these parameters, which some of the parameters captures the value of the stock, some of the parameters capture the historical patterns, for example, momentum, volatility, and all, to understand the growth. Some of the factors capture the macro conditions of it, right? So given a movement of a stock is so much dependent on multiple categories of it, we are using parameters to address those, and that is how value, growth, and momentum and other things are taken care of beyond using non-traditional data set that we use. Okay. I have a question. I'm already a customer. How do I get a discount? Okay. You are already a customer. Okay, you can reach out to us. We'll try to make sure that the same discount is applicable to your case as well. So you can reach out, write to me on csing@altcube.com or reach out to our support team. We'll provide that. Okay, and then I have a question from SA. Same, I am also a customer. These pretty small cases are pretty expensive for me. Without discount, they does not make sense. Okay, so and I think that's one of the things, that 25% is the maximum discount we can go ahead with it. And because somehow we also have to justify the amount of building and managing these portfolios, taking into account so much of alternative data. Some of them are quite paid one. So given we have to justify all the cost or operational costs that we have to take care of, we might not go beyond, lesser than these prices. But yes, given if you think it's expensive, you have a 25% coupon. That's a maximum we can help you with. Okay, PG have a question. Why is every manager having multiple portfolios? Are you just playing the probability so that whichever portfolio performs, you can advertise? I love this question. Very, very interesting question. So it's basically, let me kind of reiterate. So PG has a question to say that, okay, if I launch 10 portfolios or 20 portfolios, by probably one or the two are going to do good, right? So, and whichever is going to do good, we can kind of, advertise that. Valid question. And that is the very reason, whatever 4 portfolios we have, blue chip, multi-cap, small cap, and rising star, all are mutually exclusive. So we are not saying that large cap stock, I will put one stock in one portfolio and one stock in another portfolio. For all the large cap, we just have one stock. For all the mid cap stocks, we have one portfolio. For all the small cap portfolio, we have one portfolio. So that if we are not able to perform, we don't have, like, if let's say two small cap stocks are not performing, if they are not in one portfolio, they will be in another portfolio. No, we are not doing it. We are making sure that these are secluded. So given now, the reason we need 4 portfolios is, there are customers who will say, I'm conservative, I don't want to take a lot of risk, I trust in large caps companies. Then they have a blue chip portfolio for them. Somebody will come to us and say, no, we need aggressive portfolios, and that is why we have a small cap portfolio for it, right? So your condition or your point would have been valid if I would have, let's say, 3 small cap portfolio, because then probably one definitely will do good out of it, right? But given we are making sure we have 4 portfolios for different type of customers, and we are not kind of playing in the same segment to say I have 2 portfolios for small cap, 2 for blue chip, 2 for mid cap. No, we are not doing it, and that's why we have kept it completely separate. So we are not trying to play with probability, at least on the AltQubes, all the portfolios that we have. I hope that answers your question. Okay, can answers by saying variety portfolios to cater. Okay. Panditji is, which portfolio is your best portfolio? Like I said, there is no good or best portfolio. If you are an aggressive investor, small cap portfolio does make sense for you, because small cap portfolios usually will give more returns, but at the same time, they are more risky as well. So you should be aware of the fact that in 2020, when actually the market crashed because of COVID, the small cap saw the maximum crash. So if you have a risk appetite, you can take more risk, you should go with small cap. If you do not have a risk appetite, depending on why you are investing in it, right? You might be investing it for your, you have a tenure of a year or 2 or 3 years of investment tenure, then I think it's safe to invest in blue chip, because they might also fall, but the amount they will fall would be lesser. You have a horizon of, let's say, 10 years and or 5 years or more than 5 years, and you want to see exponential growth, then small cap does make sense for you. But then given you have a higher risk appetite, so like I was saying in the previous presentation, it is not about returns, it is about what risk you take. Given small cap, you are taking more risk, you should be, you can expect more returns, and this is, if that is what matches your expectation, go with small cap. If you don't want to take a lot of risk, you want to play with bigger companies from HDFC to Tatas and all, you can target blue chip. My understanding is blue chip performance on a longer run might not be as high as small cap, but then at the same time, the risk also associated with blue chip would also be very less. So if you believe that, depending on your risk appetite, and also you can reach out to our support team if you want us to help you with what exactly your risk appetite is. Depending on that, we kind of, try to help you with, which type of portfolio suits you. Okay, then I have a question from Ashutosh saying, gold is at all-time high. So do you use gold components in making your portfolio? Gold hedging is a very important thing. I am in a strong favor of it. So I'm in a strong favor of gold hedging. Basically, some component of your portfolio should be in gold. the whole idea is that I am planning for a blue chip portfolio with gold hedging, but currently we do not have a product. All these 4 portfolios that we have, none of them have gold in it. So it's like, and that is why even the risk profile that you see, everybody is from moderate to high to very high. We do not have a conservative portfolio for now. But having said this, this is already in our pipeline. So we will have a blue chip portfolio with hedging of gold. And this would be for our, conservative and ultra conservative folk, because when the market crashes, gold is a very good hedge, especially when you have large cap companies in your portfolio. It exactly goes the other way when the market crashes. So we should have it. But frankly speaking, in none of our 4 products for now, we have gold components into it. Okay. Then SJ has a question. Do we take fundamental ratios like ROE, ROSI, interest coverage ratio as a source of your data models? Also, do you take numbers from PL and balance sheet as a source of your model? Okay, so it's a very gray answer. Okay, maybe let me reiterate. So the question is that, do we take fundamental ratios like ROE, ROC, and all other factors, and also the P&L statements, the balance sheet, and all? Okay, so it's a gray answer in the sense neither a yes nor a no. We definitely take into account the dividend, EPS, and other factors, but not all. So how it typically works is very similar to the framework we spoke about. Is we will have some factors, we'll try to validate it. Most of the time what has happened with us is when we were trying to validate it, we were not able to make, count that as a significant factor. For example, the moment P&L statement comes out, right, if stocks are doing really good, the volatility goes so high that even if I know that, the prices will go up, probably in next 5 to 10 minutes, it will just go up. Now imagine on a small case platform, if I really have to consider that factor, I will be able to rebalance your portfolio taking that. And then eventually you will have that stock in your portfolio the next day at 9:15 in the morning. By that time, markets are super efficient. They would have already factored that information. So we do take into factors that still have an information where markets are semi-efficient and information absorption takes a lot of time. And that is what we validate with the data. If the factor, be it can be from the financial statement, takes a lot of time in absorbing it, then we do take it, consider it, of course, because this is how we are going to generate alpha. And that includes the balance sheet and PLN statement as well. But if we see that there are like EPS, if you think, especially from a trading side, right, it doesn't take time to factor in. So if the report is coming at 10:30 in the morning, I can only rebalance using that report by next day 9:15, and markets, in that one day, all those movements would have already been there. So we tend to ignore if we are not able to use that, if markets are very efficient for those factors, we tend to ignore them. Otherwise, we include them. So, but for long-term growth, definitely those are important indicators. But for a short-term horizon, no, we don't use that. Then I have a question. Do you guys also analyze the financial statement of the organization whose stocks are part of the portfolio? If yes, what basis ratio we analyze? Okay, so the question is on the financial statement. We do analyze it. We do consider them as factors. Like I said, for long-term growth, EPS and dividend is one of the key indicators. We definitely use it. But having said this, rather than analyzing those reports from the company when they publish it, we have third-party vendors that gives us more structured data, like all the 1,500 companies, their EPS, the dividend, the date of a dividend. We tend to buy that data directly, so that because eventually, because there is no human intervention, these information has to flow in a model, so it has to be end-to-end automated, and that is why we analyze it. But there are third-party data providers that structure that data, make it in a structured tabular format for us, all the information, and that information is plugged in our solution, and we use that information. But again, like I said, this is one of the factor that we use apart from all other non-traditional approaches that we discussed about, right? And then Ganesh has a question. Do we have any digital newspaper? Do you use any paid private alternative data? Yes. So we do not have a digital newsletter for now. We are a very small team of like 5 to 6 people for now, so we don't have it. We are trying to kind of start on LinkedIn a newsletter to kind of share our insights on similar topics. Our email newsletter is in pipeline, but we have to still prioritize and plan how do we do it. The second question is, do you use any paid private alternative data sources? The answer is yes. I think this is where the edge is, right? Because if you if I just go to my first presentation, it said that if everybody has the same information, everybody will be able to beat the market, or rather that information is of no use. So typically the information which is more valuable, and if somebody is collecting that information apart from the government, I say, is probably why would they offer it for free? Because everybody will use it, and the information values based on efficient markets will go off. So we do buy a lot of alternative data. And from where we do buy it, I think one of the place is alternativedata.org. It has hundreds and thousands of companies selling alternative data. Now, based on what type of segment you are targeting, what type of commodities you are targeting, or what type of equities you are targeting, you can take a call on, what data you would need. For example, you might not need a different country traffic data, but Indian traffic data during COVID times was actually helping to understand really what's the situation on the ground. There is a UK-based company called Zenscape, which kind of sell the satellite images of US inventory that's stored for crude oil. So if I'm a crude oil trader, I'll go and buy that, right? So depending on the assets you are into, we are into equity in the Indian market. So we try to buy data that is probably relevant to the equity market. So we have to do that research. And this marketplace is a very interesting marketplace, alternativedata.org. You can actually go and whatever data you feel based on the products you are targeting, you can actually find it. I'm running short of time. Last thing. Nice session. Do you provide access to international markets too? This is a small case channel, but yes, we do have a tie-up with Interactive Broker, and we help Indian investors investing in US markets as well. You can reach out to me at csing@altcube.com, and we can guide you through the process separately. But I don't want to kind of take US investing in this channel for now. But yes, we do have a US investment portfolios as well, specifically for NASDAQ. That's all. Okay, so I think the time is up. Thank you for all the interesting questions. It's a Sunday morning, taking your 1 hour. I know how much it takes, especially I don't give those Sundays at least to anyone. So thank you everybody to kind of attend that session. I just hope it justified your 1 hour of, investment of your hour, right? So thank you so much for coming. I'll stop sharing and I'll make an exit. Thank you again. Bye-bye.